Big day. It looks like the markets have had their worst April, really their worst time of it since fall of 2022. The market seems to be rushing into bonds, which is usually a pretty historic indicator of what's to come. Obviously, housing going through the roof in terms of prices, especially where I live in San Diego. Just nuts out here. I think we ranked the highest in the Schiller 20 city. Just nuts, nuts. It's crazy what's happening. What seemed to be a kind of a fait accompli that I guess a few months ago we were supposed to get something like three rate cuts, or there was all this talk of it or whispers of it, has turned. Powell has definitely turned to talk a lot less about that. But in any case, we've got an all-star panel. It should be a lot of fun to talk about. We, of course, will have Stefan Rust, CEO of Truflation, Ivan Jelic, head of data out at Truflation, Oliver Rust, head of product at Truflation, and a special guest who's always part of the panel will be Joseph Soso of DVDT.cc. If all that wasn't enough, our guest of honor today is none other than Michael Green of Simplify Asset Management. He's the chief strategist there and really a go-to guy at Fox Business. You see him all over the financial podcasts. A terrific analyst, a bit of a contrarian, and he's also someone we lean on from time to time for advice. So we'll get to him in just a second here. If you haven't already, give us a follow, do us a favor, and head out to Truflation.com. Check out, especially Truflation Premium. Right now, you can sign up for free, get the newsletter, but also there are a bunch of different aspects that institutions, traders, analysts choose from. Think of a Bloomberg terminal, but a lot less expensive and on chain and in real time. So definitely get out to Truflation.com to check that when you get a chance. Um, Again, we are doing the FOMC Fed rate decision day today. I think Powell at 2 p.m. Eastern gives his, or I should say, the FOMC gives their rate decision, and then Powell speaks about a half an hour later. So that ought to be very, very interesting. Without any further ado, any further vamping here, let's turn to the CEO of Truflation and get an update, a state of the union, as it were, of the Truflation Nation. And that is none other than Stefan Rust. Hey, Stefan, how's it going, man? Thanks for coming back on.
Yeah, thank you, obviously, and thanks everybody for listening into this, and Michael and Soso for joining and putting this on. I mean, state of the nation. I mean, it's not it's not looking very good if you look at media right now. Markets are down. I think the big fear right now from a macroeconomic perspective is where everybody's worried about stagflation. Right? Are we hitting a stagnant economy or a declining economy in terms of growth, and at the same time inflation is creeping upwards? So I think that's a big fear that the market's seeing. We still have high interest rates. I don't think we'll see a movement there yet. Be very surprising to the upside if there were any movement on the downside from an interest rate perspective. But I mean, I think markets sort of expecting a flat rate there. I think it was all to be expected. The economies are sort of segregating. It's getting more difficult and more challenging to do trade, to do business. I just got a letter from a fintech company that shared around what they are being asked to share in order to transfer money between two parties. They need to have a LinkedIn profile. They need to share a contract between the two parties. They need to share the invoice. They need to not only do that, copy and paste a lot of the chats in terms of WhatsApp chats or any other sort of email correspondence between the two parties to reflect that transaction and that trade is actually happening. So all of a sudden, to do trade, what money was there to do was to facilitate and accommodate trade. It is now getting more and more difficult to do that, especially around the world. And that doesn't facilitate growth. That is not a growth strategy. The sole prayer that everybody is hoping for to help drive growth is AI, right? AI is meant to streamline the costs, bring down, increase productivity at a lower cost basis. That is the saving grace for the economy and the drive for growth. But that is also limited to a very central number of organizations, right? A centralized suite of companies that are out there that are really dominating this and throwing billions of dollars at this, right? $4 or $5 billion. We just heard what Llama 3 is doing. We heard the amount of investment OpenAI is trying to do. You know, Elon's just made an announcement of what kind of investment he wants to make. Google, Amazon just announced something. So the magnitude of investment needed to win in the AI space is going to be limited to a set number of few participants in this. And they're obviously using the data that we've shared with them to help accelerate their business models. I think that's sort of at a higher level. That's sort of where the markets lie. We also see the demand for energy. AI is going to demand a bucket load of energy, not only energy in its raw form, but also in the ability to break down that energy to the voltage sizes that we need when we consume that energy. Not we necessarily, but the electric cars, the robots, the data centers. How are they all going to be consuming this data? How are they all going to be consuming the energy to feed and process the data, the compute needed to do that, the processing power, the ability to provide inference at the speed that we're going to expect it? Those are all challenges in front of us, but ultimately, each of those challenges represent opportunity. They represent growth opportunities. They represent wealth generating opportunities as well. In and across energy, across the AI space. How do we play in that? How do we participate in that? And how do we drive new opportunities, not just with a select few, but for the broader world and population on the planets?
Yeah, that's incredible. It is a very interesting time to be in the markets and watching the macro economy for sure. If you're just tuning in, you're listening to Truflation Spaces FOMC edition. It's Fed rate decision day. We've got an all-star panel, including our honored guest, Michael Green, chief strategist out at Simplified Asset Management. Before we get to him, we usually do some basic housekeeping around the Truflation Nation. You just heard from our CEO. We turn now to the head of data, Ivan Jelic. Ivan, it's been a busy a few weeks for you. What are you seeing in terms of the numbers? Any Can you hint to any kind of products we may be looking forward to in terms of indexes? I've heard a rumor about maybe a Rolex index. If I'm not getting too ahead of you, but anyway, thanks for coming back on, brother.
Great to be here as usual. And yeah, we do have a lot of things, and you probably ruined the surprise, but the Rolex index is definitely one of those that we are working on in the back end. And mostly the focus in the last few weeks has been on bringing new data providers for US index, and we are looking to enhance further the inflation index that we calculate for US by improving the housing category, the transportation, and also the utilities category that we will be improving and updating in next week or so. So that's one area where we focused. The second one is, as you mentioned, a lot of economic and macro data is needed, and we are adding a bunch of those in next week or two to the marketplace. So that's a huge focus for the data side of the business. And then in addition to that, we are also looking to get even more decentralized data sources and partners. You've seen a lot of partnerships happening in the last few weeks. So most of them are, or at least a lot of them are, with data partners or data providers or data partners that we will be building some of the indexes together. So it's been really busy, and yeah, that's about it.
And that's a good thing. Yeah, I saw the prediction market stuff. That's going to be really cool to see how that takes shape. Again, you're listening to Truflation Spaces. It's Fed rate decision day. Will he? Won't he? What will happen? We've got an honored guest here of Michael Green from Simplified Asset Management. He does the Simplify rather. He does the. He's the chief strategist out there. We'll get to him in just one second. And before we do, we've got our head of product, Oliver Rust, to kind of give us a sense of what's going on in terms of what you expect, Oliver, out at the FOMC. What are maybe some of your thoughts on the current state of things?
Yeah, thanks a lot for having me back on the call. Yeah, look, very briefly, look, I don't think it doesn't look too well or bode too well for the market expecting any rate cuts anytime soon, especially in this meeting. I think if you look at the things like the wage growth, which has seen a bit of an acceleration, whether you also look at the employment cost indexes in March, the quarterly release, that's gone up compared to the previous one. Unemployment has come down a bit, very marginal. Consumer confidence has gone upwards. Inflation has gone upwards. Retail sales are still relatively strong, although despite the declining GDP numbers in quarter 1 versus quarter 4. And if you also look at a 10-year yield note, it's up 6 basis points, right, to nearly 4.7%. And you look at a 30-year fixed mortgage rate, that's up 7 basis points to 7.2%, according to Freddie Mac. So, all that really does not point to any indication that the Fed is going to look at a reduction currently, at least in this meeting, and certainly for the foreseeable future, especially when you look at some of these longer term trends throughout the remaining part of the year. And then you couple that with the fact that we're in an election year cycle. It's a bit unclear about what the impact is, at least in the short term. But given looking at historical election years, you don't tend to see much more of a static decision making processes, especially in a mixed government ownership between the Democrats and the Republicans in the House and Senate. I think you're going to end up in a scenario where that short-term static environment will probably benefit the economy for short term, but of course that staticness and not making a decision in the long term is going to be detrimental. And then the longer term impact of who wins will have different impacts on economic policies and will change the outlook of it beyond that. So we're expecting, or I would expect the Fed to hold at least until July before you see any reductions, at least from the data that we're seeing at the moment.
Yeah, I think that seems to be the market consensus. And we did a poll a couple hours before coming on, and got about 500 plus votes here. And the 80% of the Truflation Nation said that they expected Jay Powell and the Fed to hold, which leads us perfectly to our guest of honor here. It's none other than Michael Green. He's chief strategist out at Simplify Asset Management. Um, just again a go-to guy for markets and analysts all over media, and of course podcasts. And we're very lucky to get him this morning. I'm sure he's going to be all over spaces today, beyond us actually. So Mike, thanks so much, man, for coming back on. We really appreciate it. And I mean, we were supposed to get 3 cuts this year, I heard, but that seems to have changed.
Yeah, no, it's very clearly changed. At most, we have about 1 cut priced in as of December, according to the kind of expectations at this point. My argument would be that the Fed will never cut unless they are forced to cut. or given an incredible opportunity, right? The inflation numbers are down. Powell had told us that when PCE was headed towards 2%, that they would be cutting because they otherwise would be too late. Of course, now that we're there, we're not cutting. And I think, unfortunately, that just leads you to the direction that says they're not going to do it until they have to.
And what do you think when you say they have to? What kind of a naive question, I guess, but what do you think will force their hand?
Well, I think we saw a teaser of it with the Chicago PMI yesterday, the Market News International PMI, which is a very good leading indicator for the NAPM PMI, the ISM components, GDP in general. That very surprisingly negative report, suggests that the idea that we've been in a recession since October is actually robust. We'll see whether that ends up being the case or not. Right? This is the real problem that we're encountering at this point. Is so much of the data sets are built very much like imagine a line, right? You figure out what happened last time, you construct your data set so that you understand it. You certainly experience this at Truflation as well, where you're building a data set, and as new data and interpretations become available, the underlying data can change. The interpretation of it can shift quite substantially. I think, unfortunately, that's where we are today, where it's very clear that we've decelerated. It now just becomes a question of how much do we decelerate from here.
Hmm. And a while ago, when we had you last on a few months back, you were keen to talk about housing, and that was prophetic to say the least. I mentioned earlier in my opening remarks, Case Shiller came out, and it's wild. Prices are going up, and mortgage rates are historic highs. What do you make of that? Is that going to factor in, or is that not something they take into account at the Fed?
I'm sure they're paying attention to it, but it's, if you actually monitor closely what's going on with this underlying data, it's fairly straightforward that the only homes that are being sold are homes that don't require significant quantities of work or are very desirable. And the quantity of homes that are being paid for in cash, whether that's assistance coming from parents or that's an accumulation of cash or second home buyers that are continuing to play through this, those seem to be the largest components of what we're seeing, right? We're seeing a dramatic increase in the number of homes that are selling above $1 million, while starter homes are struggling. Again, I just think that it like any other, think about it as a stock. If we saw high prices at very low volumes, we would grow suspicious about the durability of that rally. It doesn't mean it has to crash, but it certainly suggests that there is very little in the way of non-discretionary selling going on. And we know why this is, right? If you have a mortgage at 3%, that mortgage is currently trading at give or take 55 cents on the dollar. Nobody in their right mind wants to pay off a 55-cent mortgage at par. And so that, more than anything else, I think is restricting the quantity of product that is coming onto the market, creating the perception of incredible shortages, and simultaneously leading to many individuals saying, well, I'm never going to be able to buy a house, so why am I saving? Let's spend down some more of our money. And we're seeing the deterioration in the savings rate that reflects that.
That's a great point. I'm seeing that with some of the younger people I know. Stefan, you wanted to get in here?
Yeah, no, just I mean, we're seeing the same thing, right? I mean, just the youth that they are struggling to find an on-ramp into the real estate market. Historically, for boomers, the savings category and the store of wealth has been in real estate. Where do you see the opportunity for the next generation? Is there an opportunity for them to generate wealth, and where can they store? Obviously, they can't store it in cash anymore. So where can they store or what can they consider savings?
Well, so just very quickly, when you talk about storing, right, this has been one of my concerns amongst the young generation. They shouldn't be storing anything. They should be investing and looking for opportunities to deploy capital over a very long-term time period, right? The idea that somehow or another you're storing your wealth as compared to investing your wealth, I think, is a misuse of the term, and it's one that I actually find fascinating. because I see it in things like observations from people who talk about saving for retirement by contributing to a 401k on a continuous basis. We've heard the language, the S&P 500 is safer than risk-free bonds. I think that type of analysis is unfortunately fundamentally flawed in its underlying construction. And the simple reality is that most young people shouldn't be worried about what they're saving. They should be worried about increasing their income levels and continuing to save in the background. Um, this focus on finding the unique asset that allows them to preserve their purchasing power off of candidly what are small sums relative to what they'll accumulate over the course of their lives seems very misplaced to me.
We've got a boyfriend here in my family, and he's of a certain age. He's and he has a bit of an education, and I was giving him a round number as to what he should be making, and and I was like, "You're far from that, so you need to start making dough, dude, right away." So I think that is another prophetic take. I totally agree with you. My bias is towards savings, just because of my ideology, but I think you're right. Focus on making that cashish. We do want your questions, your comments, your takes. If you rare that you get a chance to pick the brain of someone like Mike Green. So get out here and either request to speak, we'll get you up, or hit us in the thread, and we'll try to get to your comments. Um, Sorry, Oliver, you wanted to say something?
Yeah, just a question, Michael. Given the fact that the strengths of some of the economic indicators in the market today, it could one could argue that there's even a predicament for that the Fed is in to say that they might need to maybe explore the idea of increasing interest rates again, be it another 25 basis points. But there is potentially an argument to that. And if you think out long term, based on all the comments that you've had, and also what Stefan was mentioning, keen to get your perspective is how does this roll out from an economic standpoint and from a market standpoint of when things start to change, and what some of the indicators that you see that would affect that change.
Well, just out of curiosity, what do you think, or what do you see as the indicators for why the Fed should hike?
Well, the PCE has gone up, right? So inflation and pressures are still going upwards. I don't see that coming down dramatically to that target anytime soon. I think the tight labor market is will remain tight. Whether you argue that people are having two jobs or one job, a different whole argument. But the notion that wage growth is accelerating, that unemployment rate is still relatively low, the number of new jobs enter the market remains strong. You got consumer confidence, you got retail sales. They all sort of would suggest, and the only one that's sort of counter to that most recently is the most recent GDP numbers. So, if you think about that, and the PCE, even the PCE core and the PCE and the BLS and the manufacturers price index, they're all going on an upward trajectory. And you look at some of the stock market results, earnings calls I've had earlier this week, and today, you'll see they're proving some really strong results. So it's sort of like, there could be an argument for a further acceleration of one more hike, maybe. I don't know. But just keen on your views on that, and where that all translates to.
So I think one of the things that's interesting is that we keep changing the data series to reflect what we're looking for, right? So remember, the Fed is supposed to be targeting the PCE core, which actually fell in this last report. It went from 2.84 to 2.82%. On a year-over-year basis. Yes, the quarterly accelerated, I understand that, but part of the reason why that occurred is because of the persistence of the owner's equivalent rent component, as well as some unique dynamics around insurance. I've talked about this a lot elsewhere, but there's a very key difference in the price behavior that we're seeing and the price changes that we're seeing today versus those that we saw a year ago. A year ago, we saw auto prices peak and begin to fall. Insurance costs, when you think about something like a house or you think about something like an automobile, you're insuring the dollar value, not the actual vehicle itself. And so when the price of the auto goes up, of the automobile or the vehicle goes up, you're actually going to have to pay more for that insurance because you're going to have the same number of accidents, you're going to have the same number of repairs, you're going to have all the same issues that you've historically had. And as a result, you're actually buying more insurance, but what you see is my cost of insurance went up. That's why the PCE numbers are coming in so much lower than the CPI numbers. There's an adjustment component for that in the PCE as compared to the CPI. But there's also a really critical difference in propagation. Higher auto prices drive higher insurance costs. Higher insurance costs paradoxically drive lower auto prices because it leads to fewer people being able to afford them, less interest in them, etc. Now, perversely, it also is most affecting those who are at the bottom end of the income spectrum, because if they were on the edge of being able to afford a car, and the increase in interest expense causes them to no longer being able to afford it, you'll see exactly what we've seen, which is an aggressive shift towards higher priced vehicles, more luxury oriented vehicles, etc., where the wealthy really don't care about those types of dynamics. Yes, they're annoyed to pay 30% higher auto insurance costs, but they're certainly not going to give up driving because they don't want to pay that 30% increase. They probably won't even consider giving it up for their kids. So when you think about those underlying dynamics, what we've moved from is prices that propagate to prices that actually depress. And I think that's a really critical thing for people to understand. Same thing, by the way, is playing through in home insurance, where property tax increases and increases in home insurance costs dissuade those at the lower end of the spectrum, again, contributing to the headline price increase that you're seeing in things like the Schiller, which evaluates repeat sales indices, and therefore is getting increasingly skewed towards those properties that people can ignore, things like increase in property insurance and increase in property taxes.
Unbelievable. You are listening to Truflation Spaces. We're discussing Fed rates. Should they be cut? Will they be cut? And we, of course, are listening to Michael Green of Simplify Asset Management. He's chief strategist there. We, of course, have our guest, our special guest, Yosef Soso. He's a tech guy and comes from a tech background at dvdt.cc. Hey, Yosef, you wanted to jump in?
Yeah, I actually wanted to ask Michael a question. As we saw, fast food chains and the retail sector, the bricks and mortar is not really doing very good with the earnings reports that are coming out. While we're seeing the digital, basically digital world, everything is going upwards and upwards and upwards. And the question is this: that is it because people want to save money and they're buying stuff that are cheaper, or are they becoming healthier, or because when you have McDonald's CEO coming out and say that they see that lower income people actually can't afford a burger at McDonald's right now, is that just something that they're saying to justify that people are just eating some healthy food? Is it just something as a scapegoat to blame, or is that really happening that people are really broke to the point where the lowest income population people, which consume fast food and so forth, they just really cannot afford it because of the high cost of living?
So I'll try to put this up quickly. There's a metric that I track that's basically how much money is left over after paying for everything else. And let me actually show this here. I'm going to dump this into a tweet and then I'll post it to the group. But to answer your question directly, this is a very real phenomenon. What we're seeing at the lower end of the spectrum is that there's just less money left over after paying for the non-discretionary items. That's leading to two separate components. Hold on one sec here. I'll just post it and then I'll put it into the space.
Money left over. That was the post.
Yeah, I just put it into the space.
Yeah.
So unfortunately, what's happening is that you're seeing more and more households that are being forced to make those types of choices. Now, in all candor, making choices is actually part of how an economy is supposed to work. It's actually designed to help people prioritize. The signals that you receive in terms of what people are willing to continue to spend on versus what they're no longer willing to spend on, those are really important and critical signals that need to come through the economy in order to help us allocate capital. And when we engage in things like, oh, we'll send everybody a check for $1,000 because they have less money left over, we distort those signals and lead to significant malinvestment. Obviously, we did that over the past couple of years, and now you're seeing the fairly obvious outcome from that, which is more and more lower end households are being forced to deal with paying off debt of various forms, debt that they accumulated or that they allowed themselves to ignore during a period of, the government effectively saying, we're not going to track this sort of stuff. They're now being forced to come to terms with that. And as a result, there's just less buying power down there. Now, for companies like Walmart, which are a little different than McDonald's, right? Because I will shop for groceries at Walmart. I happen to love cooking and I happen to love shopping. And I'll go to Walmart because my dollar goes farther, right? Now, if I'm going to Walmart to buy produce, I'm going to be disappointed. I'd typically go to a more expensive store to buy that produce. But by and large, I can buy the exact same brands and the exact same stuff at Walmart. So that trading down component, we've seen a lot of evidence of that. That's bringing new customers into companies like Walmart. Some similarities for things like Chipotle, where people are trading down and at the same time deciding to go for a healthier, what's perceived as a healthier alternative, complete with its own serving of E. coli and norovirus. But those types of dynamics start breaking down for people who are already on the edge. And that's really what that chart is designed to highlight. I'll give you a staggering statistic, by the way, which is if you look at the proportion of eating out, I may have this chart available to me. Let's see here. Income. There we go. I think this is going to be it. Well, let me see if I can find this in a second. But the quick answer is if you look at things like dining out, for example, where we've seen a tremendous amount of growth in the economy, the irony is that all that growth has actually come from two age groups. It's come from those over the age of 65, and it's come from those 18 to 24. Basically, young people dine out more, and old people dine out more than they had in the past. You know who doesn't dine out more? Parents of kids, because they're too damn expensive, right? And so what you're actually seeing is the largely discretionary spending continues, whereas the quality of life spending, I've lost my mind, it was a rough day at work, my kids are making me tear my hair out, let's just go to McDonald's for a family meal. Suddenly that starts costing you a crazy amount of money, and you're like, you know what, we can't afford to do it.
For sure, we're seeing that in our own house here. Sorry, Stefan, you wanted to jump in?
Yeah, no, I mean, definitely, sort of the price of the Big Mac has gotten up, and the Happy Meal is a lot more expensive, and yeah, an interesting perspective. The people that aren't going out anymore, right? We're not going out anymore because it's too damn expensive. Yeah,
No, it's true. It really is true. We just our family here, a family of five. As I speak, I can hear the pressure here. I can smell the pressure cooker. We're doing the cowboy roast, and we're going to be eating. We're going to be eating at home, and we have the last
yeah,
few nights in a row,
yeah.
which wife works, I work, and it was not unusual to go out and splurge. And it's funny. I didn't even notice it until he said it. And again, I could smell the thing cooking right now. Let's see. When you were talking last time we spoke, we talked a little bit about the election, and I guess it's a dead heat depending on who you're talking to. How political is the Fed? How well, I don't know if you can answer this, but how much are they looking towards November 5th? Is that factoring in at all into their decision making?
So, I mean, look, the Fed is always going to be political in the same way that a CFO is always going to follow ultimately what the CEO does. They may resist it, but if they don't follow along, they're going to get fired. And really, that's, the easiest
Right.
way to think about what the Fed is, as you've heard Powell reiterate over and over again, They are the fiscal agent of the U.S. Treasury. So to talk about the Fed as distinct and separate from the Treasury is largely specious. There's a number of people who have suddenly discovered that Treasury secretaries are political. I don't see how that is remotely surprising. In the context of having had Steve Mnuchin as having had Steve Mnuchin as Secretary of the Treasury, for people to suddenly wake and be like, "Oh my gosh, the Treasury is political," is somewhat absurd to me, right? The Treasury Secretary is appointed by the president; they serve at the pleasure of the
Yeah.
president, and to think that they aren't going to reflect the objectives of the president is somewhat absurd. Likewise, a fiscal agent of any entity is going to try to do what it thinks is best from a fiduciary standpoint and try to fulfill its individual objectives. But at the end of the day, if I hire Goldman Sachs for M&A and I come to them as the CEO and I say, I want to buy this thing, and they say, we think it's a bad deal, and I say, I don't care, I think you guys are idiots, they're going to facilitate me buying it. Right. And so I don't think any of this should be a surprise. There's actually a great book, The Myth of Independence, How Congress Governs the Federal Reserve, by Mark Spindell, who's used to run Potomac Advisors. All of these types of things, like, we just need to be very aware that a political organization like the Fed is going to carry echoes of that, even as they strive for independence.
Yeah, really interesting. The
I
our head of
posted.
data often
By the
go
way, I
ahead. Go.
posted a variant of that picture on Dining Out. It should be on the Nest now.
Cool. Our head of just on the Mnuchin thing. He was so funny. Do you remember he and his wife? They look like Bond villains. They had that one picture where they're holding up the sheet of money from the from the mint. Just a wild character. But our head of data, just complete non sequitur here. Ivan Jelic, he often sends us sort of headlines of what's happening in the broader labor market. And as far as I can tell, they're just layoffs galore. I'm not sure how accurate that is. Again, I haven't delved into it. But is the labor market worrying you at all, or maybe not worrying you, but is the labor market also having an impact on what the Fed may or may not do today?
Well, so I think that I think it's very interesting to think about what's happening to the unemployment rate, right? So with the millennials now in the 25 to 54 category and the prime age employment, having a much higher degree of college education, et cetera, you need to adjust for all of these things when you're thinking about what the unemployment level should be. Just historically, those with a college degree have an unemployment rate that averages about 1%. Those without a college degree have an unemployment rate that averages around 5%. As you shift an economy from those that's largely composed of those without college degrees, which certainly characterized the US economy until the 1990s, even today, there's more people without college degrees than with college degrees, although that is starting to change fairly significantly. You need to adjust for those components. And if you do that, you actually find that across measures of unemployment, we're actually already ticking through elevated levels of unemployment. Unemployment for those 16 to 19 is more than one standard deviation above the normal. The 25 to 54 is more than one standard, is the one area where it's doing very well. It's only about a third of a standard deviation above its recent lows. 20 to 24 is running elevated, 55 plus is running elevated, et cetera. But those are all small components of the economy now, right? So remember that 16 to 24 category, that's post recent baby boom, that's post millennial. The 25 to 54 category is basically millennials and the very, very tail end of the boomer generation, who are almost all now 65 plus. You're starting to see the population growth in those older age groups is leading to increased and persistent unemployment. It's also changing the character of unemployment. Those who become unemployed, particularly when they're older, stay unemployed for a much longer period of time. And so all of these factors actually play through. Again, I'll put up another chart that actually highlights this dynamic. If you adjust by interim group, the unemployment data doesn't look nearly as strong as you would expect, that doesn't mean that's the right way to look at it. Right? I could be totally wrong in looking at it that way. The Fed may be right
Hmm.
in looking at the headline, but I'll be honest with you, I think I'm right.
Yeah. And is there? I'm not sure if this is a fair question to ask of you, but I'm not so convinced as it seems most people are, or most experts are, that more college degrees is necessarily equal to more skilled labor force. I have a bias towards the kind of the opposite way, but I guess I'll ask: do you think that more people going to college, getting those degrees? I personally see the college debt bubble, college debt as a huge bubble, maybe on par with the mortgage bubble, maybe even worse in some cases. Um, what 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 do you think about college as a? So if more people are going, so I'm sorry, I'll stop there. Go.
No, I mean, what's the old joke? You know, you go to college to get lots of knowledge. You know, I think in general, college has become a rite of passage as compared to an educational destination. Um, One of my children made the very uh, insightful observation that if they want to learn something, they turn to ChatGPT because it allows them to develop a customized series of questions that helps them to understand something far better than raising their hand in lecture and having a second year grad student who doesn't speak English particularly well from behind two masks try to explain something to them. And that's, you know, at a not inexpensive school. A lot of college has become remedial because we've done such a terrible job at the high school level. And so I think it's, you know, for 30 years we've bemoaned the state of education in this country, and now some elements of it are coming home to roost. I think the challenge has been that the US has had a truly unique and capable elite education system, particularly focused around STEM degrees. Those have increasingly been filled by immigrants or foreigners. It's a wonderful thing when they stay and become skilled members of our society. And I think in general we do a terrible job of measuring human capital. Right? I mean, the single most expensive thing that anyone can have as a purchase is a child. Right? I understand you don't actually purchase them, but boy, it feels like that, and you pay for them for a long time afterwards. Um, and
Yeah, what?
so, you know, when you stop and think about that, like, what could be a better business model than bringing over talented young people from the rest of the world? That doesn't show up in our trade or capital flows in any way, shape, or form, right? We hear the language all the time from CEOs. Our most valuable resources go home in the elevator every day or work from home increasingly. Um, you know, there's no recognition of those types of components in how we measure the performance of our economy, and as a result we make bad choices, right? I think education is one of those. The objective function stopped being about education and it started becoming about degree accreditation. And if you think about it as being the equivalent of entering an elite in society, this is you know, very much tied into the work of Peter Turchin. um, they can get away with anything they want, right? If a Harvard degree ceases to mean anything from an educational standpoint, but it provides you access and entree into the halls of the elite community by virtue of your association at the university level, what do they start to focus on teaching you? They teach you how to use the right language when you're dining at an elite location, right? They start teaching you how to use your fork properly. They start teaching you how to obsess about meaningless problems as compared to relevant problems. And that's, in my opinion, what we're getting out of our education system at this point.
Totally agree. And you stepped right into it. I could hear Stefan's ears perking when you talked about um, people coming in to get an education and then bouncing and leaving. Stefan bemoans that all the time for Europe, right?
Yeah, I mean, Europe, I mean, is even worse, right? People come out of universities in Europe, they're 30 years old, they haven't worked a dime, haven't contributed in any form to the economy. Which to me is yeah, I mean, it's insane, really. The cost, the investment you do, and then let's say we want them to retire at 60, so they have like 30 years of contribution to the economy after you do 30 years of investment. The social system in Europe does actually support that. Ultimately the taxpayer pays for the education system. In the US, the student themselves either take out a loan, they're fortunate enough to have wealthy enough parents to pay for their education. And in some cases, or a large extent, a lot of international students, their parents save a lot of money and then take out the loans on their part to help fund their children to go to school in the US. So they get all the exposure to all of that knowledge and all of that, sort of educational foundation historically. Right now, it seems to be changing and going into a wacky way that we hadn't anticipated. But the worst thing is then after all of that education and all of that investment, and the opportunity cost, right? Because anybody coming in is going to take a spot for somebody that could have grown into that role and that spot at a university. All of a sudden, they're then going to leave the country. So they're not going to be contributing what they've learned at these universities to the economy where they've actually studied. But instead, they're going to take that and help build an alternative competitor anywhere else around the world. And so those are things that, how do we either build a flatter global economy where, networks can trade amongst each other, or we build a incentive structure that rewards the students to start working either earlier or participate in the economy where they've actually studied and where the investment has actually been made.
Well,
as a father of 4 children.
Yeah. Well, that was a bad choice, by the way.
It wasn't deep, I can tell you that much.
It was fun while you started, but trust me.
That was really fun. Those 3 seconds were amazing.
Yeah, it sounds like my wife's experience as well. The I think the nativist dynamic to me is less important than the recognition of the value of human capital, right? And so we're very quick to recognize assets, but not. This almost goes back to the observation about incomes, right, at the very start. We're very quick to recognize assets and how we accumulate them and how we save, but we do a terrible job of articulating how we build human capital and the value associated with that. The evidence is actually quite clear that the improvements in productivity that existed in the US economy throughout the 20th century that translated to what was called mysteriously high total factor productivity that subsequently reversed were largely tied to the qualitative components that improve human capital, whether that was better education. Remember, we started the 20th century with the average American having about 3 years worth of school education, where a year was defined as 3 months in a classroom. Today, the average is somewhere around 13 years with 166 days on average in a classroom. So we have nearly exponentially more education that goes into that labor force. You would expect that dramatically improves the productivity. Unfortunately, the returns have been very weak on further improvements, quote unquote, in productivity. I'm not the least bit surprised. I don't see learning how to identify people by their pronouns has anywhere near the productivity impact of learning calculus. That could just be my political bias. But those types of dynamics, when you factor in the improvement in education, the increased levels of education, when you factor in the improved switching dynamics from allowing women to obtain almost any job on the planet versus 50 years ago, they would have been largely limited to nursing and teaching. That what's called the switching or the job search functions plays a role as well. There's fantastic work by Charles Jones at the Graduate School of Business at Stanford on exactly this topic. And it basically says, look, total factor productivity disappears when we consider education, the introduction of better choices for women and minorities, and the experience gain in the economy that's associated with fewer people dying randomly in middle age because they cut themselves while shaving and died of a streptococcus infection. We've lost those. And so this is to a certain extent the Robert Gordon, we've had all the good stuff already happen. The next good stuff is starting to happen, but it's not yet real yet, right? So things like the implantation of genetically modified pig organs, we've now got kidneys that are solving those problems. Like, these all lead to dramatically improved life extension. But pushing life to the point that everybody just dies of dementia has very low productivity improvements relative to what we've experienced so far. The next stage is going to be figuring out how we make each individual more powerful and more useful. We did that with the introduction of steam energy that gave each individual access to basically superhuman powers on the physical front. We're now moving towards that with the introduction of AI and supercomputers in our pocket that basically turns us all into Einsteins. Right. And so what the world looks like beyond that point becomes really, really hard to see. But it is, we are at one of these weird transition points, and telling you exactly how it's going to look, man, I don't know.
Yeah, and before I bring Ivan back in, we've got some questions from the audience here. So I'm gonna, I'll get right back to you. I promise, Ivan. Let's go to. Looks like it's Euro Dollar Don. Euro Dollar Don, you are up, brother. What question do you have for the panel?
Thanks, man. So just kind of in reference with some of the college stuff, at least from my observations, and I'm a younger person, but it definitely is the what you can walk away with. And I walked away with an entrepreneurship degree and took some extra business classes and accounting and finance classes to add on top of that. And as soon as I actually started doing real finance work, I quickly realized that everything they had taught me was pretty not useless but close to it. And then I ended up talking with a acquaintance of mine that works for a private equity firm, but they also are the trustee on a public university endowment. And so I guess my question was just if you have any thoughts on that, in terms of even just the discussion of how the colleges have become less about education and more about private credit and, and investment returns and being essentially a hedge fund almost. But if you have any thoughts on that.
That's a great question.
So again, it goes back to this dynamic of price signals, right? If we were to rationally run our education system, we would do it as we did in the 19th century or periods prior to that, where a local community would say, hey, that's a really smart kid, and we need a doctor, or we need a lawyer, or we need a judge. And so we'll all get together and we'll raise funds and we'll pay for them to go study, and then they'll return and offer those services in our community. Occasionally that went wrong and the kids would take off and not participate, but in general, the social credit dynamic around that was enough to ensure that people studied for useful degrees. Things like art history were reserved for the children of the very wealthy because they could afford to study frivolous things. Today, I like to joke that underwater basket weaving has become apparently a key component of your future income stream. We stole all those signals from the system when we moved to government subsidized debt. And so you receive and pay the same tuition and the same, you're perceived as having the same credit risk when you study underwater basket weaving as when you study mechanical or civil engineering. Obviously, those are not true, right? And so everybody that is getting an engineering degree currently is subsidizing everybody who is getting a French medieval literature major. What you subsidize, you get more of. What you tax, you get less of. So we get less engineering degrees, less useful degrees, and far more French medieval literature degrees, which is fantastic for studying French medieval literature and potentially moving on to Proust. But who the hell cares, right? It's totally pointless.
Yeah, yeah. Ivan, I promised to get you back in. Go ahead. This is the head of data out at Truflation, Ivan Jelic. Go ahead.
Yeah, so just on this topic, since it's still relevant, during last month, I was at the panel at Yale University, and there was quite a lot of Yale alumni that also were part of that panel, which actually work at high positions in some of top crypto, but also traditional finance firms. And what I realized, and me coming from Croatia, where I finished the Croatian university, and that only confirmed my thinking about it. It's all about networking. But where in Croatia, it's about networking with the people, with your peers, and then as you grow, they also grow. So you have a really good network. And in those kind of universities, you also have this line, the vertical one, where you connect with the alumni from the previous generations that have really great sense of helping the younger ones. So just at one of the dinners, you can see that the senior guy from one of the companies is really trying to help one of the students that is actually in his last year of the university and is looking for a job. And as I understood it, he basically found a job there. So definitely it's more about networking and getting access to really good positions rather than getting some real knowledge.
Yeah, I mean,
Yeah.
I think most people would broadly agree with elements of that. I think it can be different at different schools, but the elite schools, like, let's just be really clear, you go there to interact with elite peers, right? If you are, this is one of the reasons that you see the outcry from individuals like Bill Ackman, because what they're really upset about is effectively that the balance of power shifted dramatically. You can be the child of a billionaire, but if you don't go to Harvard, you are not perceived as nearly as valuable to society as if you go to, East Podunk State. They're understandably frustrated and annoyed that it's harder to get their children and the children of their friends, who they'd like to continue to perpetuate an American aristocracy, into those schools. Right now, that doesn't mean the schools are making good choices, right? But the schools have developed to become exactly what you would expect in an environment in which a degree from Harvard is a precursor or a requirement to saying, I'm a member of the elite. Then you're going to have more and more behavior that is around a finishing school as compared to actual education. And for what it's worth, by the way, that's actually just a return to what Harvard really was in the 19th century. It was largely about the children of the elite receiving an education that was appropriate for them to say, yes, he's a Harvard man.
Yeah, if you ever want a head kick, look at the Supreme Court justices and the schools they went to. It'll really blow your mind how uniform it is. We've got another audience listener question here from Stonks Whisperer. You're up, brother. What question do you
Yeah,
have?
guys, thanks for having me on. Just a quick shout out to Truflation, Mike Green. Thanks for doing this today. This conversation has really come into really my question, so it's great to hear this. So as the conversation around the value of college is louder today than really in many years past, I view college today as more of a social sorting machine, a place to find a spouse, a place to network. And so just curious, what other options are out there that might be a better value, both in terms of dollars spent and time for parents, and to encourage their children to pursue? Thanks.
Great question.
Boy, first of all, everybody's situation is very unique, and I certainly don't have a crystal ball. What I have encouraged people to recognize is that the value of a vocational education rises the fewer people receive it. That doesn't mean go become a plumber. It means actually go do a vocational education. So I have 3 children, all of whom I think are fantastic. One studied philosophy, much to my chagrin. The other 2 are in vocational programs. One's at the University of Pennsylvania's Wharton School of Business, which is a very prestigious vocational program in which you study applied economics. It's called finance. Another one is at the U.S. Naval Academy, where you have an applied degree in basically how to kill people. I think both are particularly valuable skills on a look forward basis.
Yeah, yeah. We're getting on to a hard out here. Mr. Green is in big demand, especially today, and you can hear why. He's just put on a clinic. We'll go to the last question here from Joseph Soso out at dvdt.cc. Joseph, you're up. You've got the final one, brother.
Hey, first of all, I was just thinking about, imagine parents not eating at McDonald's to save money for kids' college, and then they go to the colleges the way they are today. But that's a different story altogether. The question that I actually had for you is that, like, moving forward, I think what's on everybody's mind is for the Fed to cut the rate, right? What are like some of the three steps that we should be looking forward to or seeing as sort of like like an oracle of the Fed might just go ahead and just cut it down, or what would be some of these like miracles that need to happen for the market to stop bleeding?
Well, first, let's be really straightforward, right? When we talk about bleeding, while the median stock is struggling significantly, the Russell 2000 equal weight is now down about 7.5% for the year. Although today it's actually up, so we're seeing slightly different behavior here. I would be hard pressed to say that there's a ton of bleeding out there with broad indices up 5%. Yes, bond prices are down, but the total return for most bond indices is only modestly negative for the year. BND, which is the bond aggregate, is down on a total return basis. Hold on a sec here. Oops. I tried to pull up what the return was in 2020, 29, 23. So you're down about 4% in the broad bond indices. Now that feels terrible, but it's not. The average asset is basically flat for the year if you're running a 50-50 portfolio. So I don't think that asset markets are what's going to cause it yet. I think what you are starting to see is some concern around the impact on small businesses, and to a certain extent that would include things like commercial real estate, which tends to have a high correlation there. I would just emphasize that really is kind of the key thing that we're going to be watching for is actual real world deterioration. I think unfortunately a lot of people are very focused on the unemployment numbers. As I've articulated elsewhere and pointed out, I think that data is increasingly meaningless. For the very simple reason that unemployment benefits are so low in inflation-adjusted terms, and the requirements around unemployment is so restrictive relative to alternatives like driving for Uber or delivering for DoorDash, particularly when you consider that you're able to bring an asset to that second job in the form of a car that you happen to own or are already paying for. You're able to convert that asset into higher cash income, effectively running the depreciation dynamic. And so it's just causing a lot of the data to not mean what I think people think it means. So with all of that said, I think the only thing that really is going to cause the Fed to substantively change is the same thing that causes it to change every time, which is an actual break in the system that causes people to say, wait a second, that's not quite what I thought, right? The GDP report in Q1, probably not enough, right? Strong evidence of slowing. And I want to point out for people that if you actually look at it on a nominal basis, the nowcasts missed by like 250 basis points. This was a huge miss in terms of expectations on a nominal component. But it's not enough yet. And so, I would say we're going to have to see worse performance from financial assets and a continued deterioration of some of the real world components. How quickly that flows through is, I think, very hard to see. What I think the Fed should be doing is actually, for once, behaving in a proactive rather than a reactive way. They know that they actually have very high real interest rates. They may be puzzled in terms of why that's not flowing through yet. I think that's been pretty well articulated. The Fed itself has done phenomenal research on this. And my biggest fear is that the neo MMT argument that high interest rates are actually proving to be somewhat stimulative to the economy because they transfer immediate income into the hands of those who have cash, while the process of rolling over debt with higher coupons tends to be relatively slow. That is actually true, and when the Fed goes to cut, it actually leads to a decline in income levels that then causes this whole process to accelerate downwards.
You are listening to Truflation Spaces, and that was the great Michael Green, chief strategist out at Simplify Asset Management. Michael, where can people follow your work and keep up with all that you do?
Well, as you point out, it's harder to not find me than to find me these days. So I would encourage people to check out the Simplify website at www.simplify.us. I put out a morning note as part of the Tier 1 Alpha team. We often reference the work of Truflation in there. And then I also write a Substack called yesigiveafig.com.
Boom. Mandatory follow, mandatory listen. Green always comes with alpha. And wow, what a great spaces. If I do say so myself, patting myself on the back here.
And
Yosef,
subscribe
how can
to.
people follow you?
Sorry, I just got to interrupt. I just got to subscribe to Michael's emails and newsletters. I mean, they're really insightful and deep. Really good. Good. I really enjoy those, Michael. Just want to let you know.
That's very kind of you. Thank you.
Boom. And last but not least is Yosef. How can people follow you, brother, and follow your work?
Well, I usually have a lot of fun on my Twitter. I started it recently, but overall speaking, we find you. You don't find us.
There you go. I like that. All right, guys. What a great spaces. Thanks, everybody, for tuning in. We're back in just a couple of weeks with the CPI inflation analysis. Until then, we appreciate you checking out Truflation.com. And thanks again, everybody. We'll see you in a couple weeks.
Thank you.
Truflation.com. And thanks again, everybody. We'll see you in a couple weeks.
Thank you.